Hi, everyone. We would like to talk about this topic that is analysis of financial statements. Friends, we understand it well that we prepare a set of financial statements which are primarily based on some rules and conventions, something that we, of course, refer to as India's standards. And this is all we have been studying so far with the help of different modules of the ICAI. All right. Now, when I say we are looking at understanding those India's standards, the idea is basically that why do we need to understand those? Why do we need to study those? Why do we need to have a set format of presentation of a balance sheet or a statement of profit or loss account? Why do we need to have a set manner in which we, for example, prepare the statement of cash flows? Why do we have specific provisions with respect to, let's say, the policy choice for property, plant, and equipment, whether we use a cost model or a fair value model or a revaluation model, as we call it, right? The idea is that when we follow these set rules and principles, people would look at those financial statements and they would like to take a decision about the financial statements, right? Whether the company is doing good, whether the company is doing bad, is it good in one particular area and bad in a few more, and so on and so forth. And that is where all these aspects would be driven towards the analysis of financial statements. End of the day, these financial statements try to communicate. They try to communicate about the health of the company. They try to communicate about the performance of the business. They try to talk about the liquidity aspects of the business. And that is where it is imperative. That is where it is important that they speak correctly, that they are presented in the right manner. They are presented in a consistent manner. They should reflect something which is appropriate, all right, relevant, complete, at the same time concise. It cannot be too much of an information thrown back onto us. And that's the reason why this section, this topic, would want us to go back and see to it that we have studied all these in days, right? How do we make sure that we are able to apply, we are able to analyze the financial statements, having understood those, the concepts under the Ind AS already. Okay, so when you look at this entire section, we want to discuss what are the key features of the financial statements and the relevance for better reporting. End of the day, it's all about a cleaner, transparent reporting, right? It's all about the need for the users to be able to understand what is exactly depicted by these financial statements. Otherwise, what is the point? What is the point of even preparing the financial statements if these are not prepared in the right manner? Okay, what are the key factors? The second point that we see, what are the key factors to be kept in mind in the preparation of financial statements, and what are the best practices in the preparation again, right? While there could be some conceptual aspects of true and fair view as we hear it in our, or in our entire accounting career, right? The true and fair views perspective, relevance, consistencies, and stuff like that. We'll see them all as a part of this particular standard. The examination has been, expecting, or the examination expects us to be knowing also again about the application of accounting standards. Are they done appropriately or not? Now, these could be with respect to the presentation part, right? In terms of whether something should be presented in a current side of it or a non-current side of it, or it could be with respect to the measurement part. Something should be measured at cost, or something should be measured at, let's say, revalued amount, or let's say net realizable value, and all that stuff as is applicable. So we would see basically the analysis of financial statements is a bit more comprehensive, bit more elaborative subject, right? In one way, we may say that whatever standards that you have already been through, it's a little summary of that stuff again. So you would see a lot of focus on the presentation with the help of the concepts that's, by the way, already covered in the Ind AS 1, which is presentation of financial statements. But at the same time, it also talks about the application of the other standards, as we will see. with the help of several questions and case studies. All right. So when I look at this particular standard, it again, as we said, that it talks about the analysis and correction of mistakes. Now, where would you see the corrections coming in? Wherein probably somewhere the Ind AS are not applied correctly. And that is where this section of analysis of financial statements becomes a little more elaborative. They can probably ask anything. They can ask anything from any standard, right? So we should be a little more open to understand that we have done these things in the past. We've already done these things in the past. It is just that we want to now look at the relevance of those in terms of why probably I need to ensure that all my financial statements are corrected. So any errors made which appear on the face of the given scenarios, for example, they should be corrected from that perspective. While my other questions would normally talk about, right, how should you apply a particular scenario, or what is there given in the standard. In our scenario, it might be in this particular topic's case, it might be a case that we are giving our own information and they expect us to correct that, giving the principle or the underlying principle from the standards perspective. Okay. Now, since last few years, since May 2015, this examination, this topic has been tested only once, but it is a relevant topic any which ways. I mean, we're not doing a lot of extra effort to understand or learn more about this. It's purely coming back with the help of all the other standards. So what we don't expect to do is cover all these standards all over again. But what we certainly want to do is spend some time on the concepts, right? Looking at those attributes or characteristics of the financial statements, and then we look at several scenarios, right? In terms of given a scenario, if there is something which appears to be incorrect, if there is something that appears to be wrong that needs to be rectified, and why it is to be rectified, what is that underlying principle, is something that we need to quote as a part of our, all right? So when I look at this particular scenario, we talk about, of course, the attributes and the introduction. We have briefly talked about the introductory part of it. And when I look at this entire gamut, the financial statements of corporate entities, it is very much identified under the Schedule 3 of the Companies Act 2013. Of course, the entire Ind AS 1, which is read along with the Schedule 3, has or gives a complete information about in terms of what is that particular format that we need to follow, what is that content, what are the minimum line items. You would remember in AS 1 we have talked about that. What are the minimum line items that appear on the face of the balance sheet, on the face of the statement of profit or loss. Okay. Similarly, there could be several additional disclosure requirements with respect to the elements of the balance sheet and the statement of profit or loss, which are again a part of course, my financial statements, right? Some industries like insurance business, banking business, right? So these businesses would normally have certain formats. Could be a regulatory, format. For example, in case of banking entities, it could be driven by the Reserve Bank of India. Or for example, in case of the insurance companies, there could be specific information of the formats which are prescribed by the regulators, like you have IRDA, the Insurance Regulatory and Development Authority. Right. So you start looking at those aspects, and that is also being covered, as a part of, the standards, but specifically that is not covered or, would be applicable to those companies directly. So from an examination standpoint, we don't expect that those formats with respect to the insurance companies or banking companies are going to be tested for us. We are purely looking at something which is applicable as per Schedule 3 to other sets of businesses, right? So any other industry would need to apply the Ind AS, including the format of the balance sheet and the statement of profit or loss as per the general statements. That's where you start looking at it. Okay. Of course, we understand that as per Ind AS 1, it suggests, the Schedule 3 suggests the vertical format, all right, and also the minimum items on the face of the balance sheet and the statement of profit and loss. We just talked about it. Ind AS 1 is a very elaborative standard which gives all that information as well. So it's basically a little more overlapping of what we have studied under Ind AS 1 is being again talked about here. All right, so we don't have to really spend a lot of time on this particular discussion. Okay, so they're all the requirements and the disclosure requirements of respective Ind AS are over and above. So they're all a part of the coverage, and that's what we want to kind of talk about. Accordingly, the Schedule 3 covers everything. The formats of the statement of format of the financial statements, the disclosure requirements, and also those disclosure requirements becoming a part of the notes. There's a sequencing that we need to follow when we are preparing those sets of notes as well. Okay. Now, attributes of a good financial statement. Now, you may be aware, by the way, the ICAI awards many companies for the best presentation of financial statements, which is more towards are the companies taking sufficient care to ensure that all those expected information is also, let's say, brought into picture. And that is where probably it becomes important and interesting for us as accountants to know about why probably we need to know these attributes well. I mean, the companies may seek, and would obviously become more of a branding statement or a goodwill statement, where we look at the right presentation of financial statements, and of course the institute recognizing that effort as well, right? So that's where we say the ICA is the recognized accounting body, including or issuing these accounting standards, and these are mandatory for the entities operating within India. Of course, there are also converse set of Ind AS which are adopted and notified by the Ministry of Company Affairs, and almost all of the largest entities are now required to follow those. Okay, so the attributes that you see, and that is where our next few slides are going to be talking about these. The attributes to any set of financial statement to talk about, yes, they need to be compliance driven, right? They need to be not really, what do you say? You should not be really, compromising with the compliance part of it, and of course they need to be looked upon from an understanding perspective for the general set of preparers, and that is where the relevance of true and fair view, or the importance of true and fair view comes into the picture. And likewise, you talk about, of course, the information that is presented with the financial statements. They need to be relevant. They need to be logical, in the sense that they should be understood and they should be consistently present. Now, it could be a little theoretical, but let's try to understand these points one by one. When I say I'm referring to understandable, do I expect, for example, somebody who is not an accountant, let's say I'm talking about a doctor, for example, or let's say I'm talking about, let's say, an engineer, would they be expected to know what these financial statements are trying to say? Well, the answer is no. Do we make it understandable to these people as well? I mean, they're all professionals, but again, the expectation is no. The whole idea about understandability here is that, ideally speaking, right, my financial statements should be understood by the people who understand the business, and also they understand the general accounting part of it. Right? So they should not be too, it shouldn't be too complex for people to be able to make a meaning out of that. Okay. Similarly, the consistency part suggests that I should be following the formats, for example, or if I look at, for example, let's say, the presentation part, they should all be consistently done. It cannot be just done, as in, you use a particular format in one year and you use a different format in another year. You present one element within one grouping and then you present that element in a different grouping altogether. It could be upon application of the accounting standards as well. If I were to say, I'm using a FIFO method, let's say, for inventory valuation in one year. In the second year, I start following the weighted average method, and I keep on doing it every year. I keep on changing it without a clear, reasoning behind that. So that's where we start looking at the consistency framework is affected, and that is what is not allowed. That is what need to be taken care of, right? Of course, in this case, it also impacts the true and fair view, right? That's where it's a bit more detailed. True and fair view is the term using to express the condition that financial statements are truly prepared and fairly presented. Okay. Now, the easy part I would like to kind of bring it is that instead of making it theoretical, in case an entity is following the Ind AS, the true and fair view is assumed to have been achieved. If you're following these standards, in the spirit, then the true and fair view is very comfortably achieved. So that is where you make it a bit easier, right? When you say, of course, true, you're trying to say that it is not carrying any material misstatements, whether due to error or fraud. Now, again, you go back. The moment I say an error or fraud, you talk about Ind AS 8, for example, right? Likewise, fair means that the financial transactions are treated fairly and all information, right? All significant information is sufficiently disclosed. So that's where you start looking at it. Compliances, of course, would relate to the legal compliances or a standards requirement or a rule, from a policy formulations perspective, and that is where this word compliance or regulatory compliance is addressed here, right? When I say, of course, it would be about regulatory compliance describes the goal that organizations aspire to achieve in their efforts to ensure that they are aware and they comply with the relevant laws, policies, and regulations. I think these aspects, accounting and regulations, they go hand in hand. I mean, there are standards, of course, where you start talking about the revenue recognition, right? The standard on revenue from contract with customers. Now, this is something which is, of course, a very somebody, we may say it's an accounting standard. It is an accounting standard, of course, but at the same time, we talk about the collectibility criteria, and that's where the collectibility from a normal courts perspective, from the legal perspective, could be important. So you start bringing them hand in hand. We talk about accounting for, let's say, contingent liabilities. Again, you need to look at the legal recourses. You need to understand, what is the law of the land and how are you complying with that? What is the gap in that, etc., to be able to suggest or confirm in terms of whether this reflects an appropriate regulatory compliance or not. The universality is basically all about comparability, and importantly, the Ind AS one also reflects that if I say I'm looking at company X, preparing its set of financial statements. Now, the comparison has to be both for company X current year and prior year. At the same time, it also has to be comparable with the industry. Okay, so it is not only confined to me comparing my own performance with respect to the previous accounting period. It is also to do with how am I performing as compared to the industry person. And that is where you start looking at, if you are, for example, two different companies in the same industry, right? So they should be, of course, comparable, and it does not really matter a lot whether you are based out of one jurisdiction or another. And that is where the word universality, comes into the picture here, of course. Okay. This would be straightforward. Again, relevance part suggests that is there something which can affect the decision making of the users, right? We may also say, isn't that materiality? Well, to some extent, yes. But at the same time, we are referring to the fact that the users will take a decision. So if I'm a shareholder in a company, I would read through the financial statements so that I can take an investment decision. Should I continue with that investment in that business? Should I put more money into that, or should I pull out my investment altogether? All right. Now, importantly, when you say that, looking at the relevance part of it, you cannot afford to give or you should not be giving any irrelevant information in the set of the financial statements, because the users will have always a limited time. They have to take a decision. So they cannot be overburdened with the information which is redundant, for example. Okay. Now there's an example which suggests that how the relevance and materiality they would come together. It says that a default by a customer who owes, let's say, 2,500 rupees, and the company has a net worth of 25 crore rupees, may not be relevant. I mean, people may not want to look at that specifically. However, if it were 5 crore rupees, then it's a relevant information, and it should be presented correctly in the financial statements as well, right? So that's how you start looking at the word relevance having its practical applicability. Understandability, we have already discussed about that. It says that the financial statement should be readily understandable by users, and this is important, who are assumed to have a reasonable knowledge of basic operations of the business. All right. You don't expect, of course, as we were using that scenario earlier, you don't expect that only accountants are going to read the financial statements, right? But then the next argument that comes, are accountants, if given any set of a balance sheet or a profit and loss account, would they understand it entirely? Again, it may not be correct. That's where we say somebody who understands reasonably the business, for example, they should be looking at it, the financial statements, and these statements should be understandable for them. It should not be too complicated, too complex, too many jargons used in accounting and stuff like that. So it's an example given here. It says that an exploration and production company, which is in the business of natural gas and energy, maintains well and perform exploration activities. The company has defined recognition of assets related to such exploration activities in its financial statement. Now, it's already a complex business, all right? Of course, the users of financial statements need to understand the business as well. And those basic definitions, the basic terminologies which are a part of this business, you're not expected to, you as management are not supposed to, let's say, give a detail of what is the meaning of, let's say, mining, what is exploration, what are the different processes. If you want to give, that could be a question to argue, but you're not supposed to, because that's where the people are expected to understand these already. Okay. However, importantly, if there is a different term or there's a change in any term being used, then in those cases, they need to be, of course, disclosed or explained correctly there. Okay. Consistencies, we have discussed it. So I think just to read through the scenario, it says that when you share those financial statements, the format should be consistently used. At the same time, you need to look at consistency in the presentation, in the measurement, in the accounting policy choice, etc. So everything is about consistency, right? So I think the basic example which is stated here, it says that company Y incurs certain expenses which it has grouped under cost of sales in the last year. However, in the current year, the company has shown the same expenses under general expenses without regrouping the previous number. So this is purely, an example of inconsistency. Now, again, if you look at this scenario, of course, from a presentation perspective, it's a change in accounting policy. It's a change in accounting policy, right? So which automatically suggests, as we all understand, it automatically suggests we need to do it on a retrospective basis, right? We cannot and that's where we say again, applying Ind AS in entirety is a classic example, is a classic way to agree that it's an example of a good financial statement. All right. This is the quick discussion that we have done. So just to quickly revisit, these are the 4 or 5 points that you want to remember. You need to achieve a true and fair view. We look at the regulatory compliances, relevance, universality, understandability, and consistency. Of course, the formats are driven by Schedule 3 with respect to the minimum requirements, also disclosures, as we know it already under Ind AS.